Welcome to this explainer. I'm going to be your tour guide today as we navigate the totally fascinating and, let's be honest, wildly unpredictable world of business finance and tourism. Just picture it. It's a highly dynamic industry. Literally, one day you're dealing with a massive surge of holiday bookings, and the very next, a sudden weather event, a health concern, or even a transportation strike completely flips the script. So let's dive right into this. Just ask yourself, what actually happens to a gorgeous beach resort when the rainy season hits and the tourists just vanish? Well, the staff still needs to get paid, the electricity has to stay on, and the buildings definitely still need maintenance. This right here is exactly why every single tourism manager, from the front desk to the back office, absolutely must understand how money is obtained, protected, and used just to survive. Here's our itinerary for today's explainer. We're going to hit navigating the tourism industry, look at 4 key financial decisions, figure out surviving tourism's seasonal swings, weigh profit versus long-term value, touch on ethics and financial management, and finally, putting it all together. Let's get going. Stop number 1, navigating the tourism industry. Now, when you hear the word finance, you might immediately picture Wall Street bankers in tailored suits, right? But for tourism managers, it's actually an everyday survival tool. It's how you handle room rates, employee schedules, and tour packages. To really grasp this, we need a bit of a paradigm shift. Look at accounting. It's all about the past. It's recording what already happened in historical income statements and balance sheets. Finance, on the other hand, it's like a forward-looking telescope. It takes that history to actively forecast and make critical decisions about the future. Which brings us to Section 2, 4 key financial decisions. Think of these choices as your essential everyday toolkit. But before making a move, a manager follows a pretty standard 6-step process. First, you identify the problem or opportunity. Next, you gather the relevant info, then estimate the costs and risks involved. After that, you compare your alternatives, select the absolute best route for your goals, and finally, and this is crucial, monitor the results to make sure your decision is actually working. So what are those key decisions in the toolkit? Well, the first one is investment decisions. This is all about acquiring long-term assets or funding projects you expect will generate future benefits. Say you're a tour operator thinking about buying a new passenger van. This decision goes way beyond just looking at the sticker price. You've got to evaluate the fuel consumption, the insurance costs, the driver's pay, and most importantly, is that van just going to sit empty during the off-season? Once you decide to actually make that investment, you hit the second step, financing decisions. Basically, where is the money actually going to come from? You could get a bank loan, right? That lets you expand quickly without emptying your own pockets, but it definitely adds interest expenses and strict payment schedules. Or you could use the owner's personal capital. That keeps you out of debt, sure, but it significantly increases your own personal financial exposure if things go south. The third piece of the toolkit is working capital decisions. We're talking about managing short-term, daily operations. And here's a massive takeaway for you. Even a highly profitable business can completely fail if it lacks working capital. Think about it. A travel agency might have incredibly high recorded sales on paper, but if the customers haven't paid their invoices yet and the agency literally lacks the cash today to pay the airlines or their staff, well, that business is facing an immediate crisis. Finally, we've got dividend and profit distribution decisions. When the business makes money, what happens to it? Managers have to strike a really delicate balance here. Do you distribute those profits to the owners right now as a reward? Or do you responsibly retain those funds for future expansion and emergency reserves, just to ensure the business can survive any unexpected shocks? Moving right along to Section 3, surviving tourism's seasonal swings. Seasonality is arguably the most volatile factor in this entire industry. We're talking predictable but massive changes in demand driven by holidays, school breaks, or stormy weather. Notice how fixed costs remain completely steady across both the peak and low seasons. Things like rent, property insurance, and base salaries. They persist even when the revenue absolutely plummets during the off-season. You've got to pay those bills, whether your hotel is packed at 100% capacity or totally dead at 10%. And the real reason this hits tourism so much harder than, say, retail is perishable inventory. In retail, if you don't sell a pair of shoes today, whatever, you leave it on the shelf and sell it tomorrow. But in tourism, you can't put an unused hotel room on a shelf and sell it tomorrow. I mean, not unless you have a time machine. An empty airline seat or an unused tour slot tonight is a revenue opportunity that is lost forever. You literally can never get today back. So how do managers actually beat seasonality? They use some very specific financial and operational tactics. They build up massive cash reserves during the peak periods, offer off-season promotions to keep at least some money flowing in, utilize flexible employee schedules, and aggressively diversify their revenue sources. Going back to our earlier example, a beach resort's strong summer cash flow just cannot be handed out as profit to the owners if they actually want the business to survive the rainy season. That cash is essentially their winter life raft.
All right, Section 4, Profit versus Long-Term Value.
Every single tourism business faces this conflict at some point. It's the ultimate dilemma, making a quick buck right now versus building a lasting, trusted brand. When we compare these two paths, profit maximization focuses strictly on increasing immediate revenue over expenses. Value maximization, on the flip side, grows the long-term, deep-rooted worth of the business. For instance, you could cut the maintenance budget to boost short-term profits this quarter, but then your facilities deteriorate, guest satisfaction plummets, negative reviews pile up, and you completely destroy your long-term value. It's a super dangerous trade-off.
This brings us to Section 5, Ethics in Financial Management.
Because managers are constantly handling other people's money, funds that belong to customers, owners, and suppliers, establishing strong ground rules is absolutely vital. These core ethical pillars are simply non-negotiable. Transparency and accuracy required. Managers must be strictly accountable for resources and completely avoid conflicts of interest. Like the forbidden practice of hiring a relative supply company without disclosing it. And importantly, since tourism often relies on advance bookings, customer deposits must be protected in a metaphorical vault. They can only be used for legitimate business purposes and never, ever used to cover a personal cash shortage. No way.
And finally, Section 6, Putting it all together.
We've covered a ton of ground today, so let's bring all these concepts out of theory and into the real world. Let's take the story of a small island boat tour operator. Business is booming, and the owner wants to expand their operations by purchasing a second tourist boat just to keep up with visitor demand. Notice how this one single business action simultaneously triggers all four of those major financial decisions we discussed earlier. Buying the boat, that's the investment decision. Choosing whether to use personal savings or get a bank loan, that's the financing decision. Making sure they keep enough cash on hand to pay for extra fuel and a new crew before the new tourists actually start paying in, working capital decision. And deciding to use this year's profits to fund the boat rather than paying the owners? Yep, that's the profit distribution decision. All of this while carefully forecasting those seasonal weather risks to ensure the boat doesn't become a massive financial burden during the off-season. Everything is just so deeply interconnected. As we wrap up today, I want you to consider this defining principle. Financial management seeks to balance profitability, liquidity, risk, continuity, sustainability, and long-term business value. Finance and tourism isn't just about counting pennies or, plugging numbers into a spreadsheet. It's a highly strategic, careful balancing act designed to ensure the business thrives through the peaks and valleys of a very wild, unpredictable industry. Which leaves us with this final provocative thought to chew on. When we make financial choices that affect our staff, our facilities, and our local communities, what is the true long-term value of the travel experiences we create? Thank you so much for joining me on this explainer, and I really hope this helps you successfully navigate your own financial journey in the world of tourism.